See about components of options. What are all the components and main features are there in options, and we will use in day-to-day life. So let's see. Let me make myself little down. Okay. So now first one is underlying asset. What is underlying asset? For example, options are like you're not going to buy an entire asset. Again, I'm saying, like, even if you see the previous video, you will be knowing. Options, we are not going to buy underlying asset. We are just going to have a contract. We are just going to have a contract, and we are just going to have, we are just going to pretend that if it's like going on our direction, we are just going to make profit, or if it's going out of our direction or out of our plan, it's going to be in a loss. So that's what exactly we are just going to do. So for that, we are just going to choose an underlying asset, because in options, as I told you, we have lot of assets to do options, like index, or you can have, like, for example, Apple, Microsoft. For example, if you take an Apple, this word we can take it as an example. Okay, here I just give an example as an Apple. So in Apple, what all things are there, we are just going to see. The main thing you need to note down is, see, first we just choose the company called Apple, because we are just going to trade options on Apple. So we are just going to trade on Apple. So for that, we need to find out a price, because fixing a price is your choice. As I told you, if you're doing option buying, your profit is unlimited, but if you're doing option selling, your price is limited. So in option selling, the premium of that $5 or $100 or anything, this is going to what you're going to earn from each and every premium you're going to sell. Because not only one person, not only I am, like me, thousands of people would be there. They all will be coming together, and they will buy your contract, and they will be promising you that I'm just going to sell your land, like piece of land, for this price. Like, for example, we can they will say, I will sell this piece of land, we can have a contract of $5. Not only you, like you, lot of brokers and lot of people should be there. They will be saying, I'm just going to invest that. So these $5 from lot of people, which you're going to make as a profit. But here, if someone sold out, or if something is not going on your direction, you're just going to make a loss. But everything you just planned, you just sold with, for example, option sellers, where they make money is, for example, you just made a 6 month of contract. In this 6 month, if someone is not selling a land as they promised, what will happen? Your $100, what you just promised, it's going to be yours. You got my point? So for that, you should be little bit thinking a little bit cunninger that they should not sell your land. So for that, you need to do lot of things, like research how much price you can have, because if you have 10k, they can easily sell it. If you have 100k, you cannot sell it. So that's where option sellers are making profit. But the problem is, when you keep 100k of your land price instead of 10k, what will happen is only few people will show the interest, because in next to your land, some are selling in 10k, some are selling in 50k, and as a retailer, what I will think is, why I need to have contract of $100 for you? Because selling for 100k is impossible, or it's possible only if I get a buyer. So instead of $100, I will say I will give like only $5 or say $2 for a contract, because selling for this price is very, very riskier. So if I sell this, you can give me my money back. If I'm not like selling this, you can take my $5 or $2. He will say, okay, it's fine. So like you, lot of people will be giving $5. He will collect all the things, and who is going to sell it, he will give the money back to him, and who is not going to sell it, he is not going to give the money back to him. So that's what exactly going to happen. So if you connect this inside the market, that's what lot of things would be coming, which is nothing but the strike price. So choosing a strike price, there are a lot of things are there. One is ITM, which is in the money. Another one is at the money. And the last one is OTM, which is nothing but out of the money. So ITM, ATM and OTM. So these are all the money which is followed by the current price. Okay, so let's go little deeper. What is ITM, what is ATM and what is OTM? So let's assume now the current price of Apple stock is $100. Okay, just assume current price of Apple stock is $100, and in that, what are all the the money market? For example, what are all the things? For example, what is ATM, what is OTM, what is ITM? So for this full form, I just said you ATM is nothing but at the money, OTM is nothing but out of the money, ITM is nothing but in the money. So for example, if you have $100 and strike price is nothing but they will have a contract based on $5 different or $10 different or $20. For example, it will start like from a current price like $100. It will have a gap of $5. So 105, 95. So in this we can assume this is the one contract, this is one contract and this is one contract. In this, which one is at the money? At the money is nothing but which is not like from above 95 above $95 and below 104 like $105 will come under ATM, which is nothing but at the money. At the money is nothing but you just assume that the price would be stable at the same point, or the price would be going up or going down based on like you're going to do put or call it secondary. At the money is nothing but at the strike price. In the money is nothing but, like for example, now we can assume for long is nothing but call options. For call options, this is going to be in the money, ITM. ITM is nothing but which is considered as inside the at the money, like inside the at the money is nothing but it's like below the price of $100 if you go with the call options, and above $100 what are all the contracts are they which is considered as OTM, which is nothing but out of the money. So if you come to a short, like if you come to the put option, this will come as ITM, this will come as ATM, this will come as, one second, let me erase this. I need to erase this, but okay. So this will be coming as OTM. This will be coming as OTM. So in this you can see the difference. You're just going to bid something, or you're just going to put the contract based on what kind of options you're going to choose. If you're choosing a call options, then you should follow this method. You need to focus on market should go in upward direction. If you're focusing on like a put is nothing but, for example, you're just going to take a short entry in futures, what you will assume market should fall down. So only if the market is falling down, you're going to make a profit when you take a put as a buyer. Okay, but if you take a put as a seller, then you should focus on OTM, because only if the strike price is going above the ATM, you're going to be in profit, because no one has been promised, no one has been sold out the things as they promised. So you're going to make the profit when the expiry has been happened. So this what in simple explanation. In upcoming videos, I will try to make even more understanding. But here we can see the next part. Now you understood, right? What is strike price? Strike price is nothing but which is going to be chosen by you by ATM or ITM or OTM with what kind of options you are going to trade. With that, we are just going to mix up with analyzing, or with whatever things you're going to do, you can analyze with that. With that, you're just going to choose the strike price, whether it can be $100 or $105 or $95. It's totally your wish. Strike price, these are all called as strike price. And the $100 of stock price is considered as the current price. So you should not confuse with the current price with the strike price, because strike price is chosen by you by saying like market can go up, I'm just going to put the contract this much, it can go up, I'm just assume that, and you're just with your prediction and everything, you're just going to assume and you're just going to put the contract with them with the month or with the week or anything. So that's how the strike price will work. So here I just given a clear example. Okay, but this what? And next one is expiry date. What is expiry date? Already I said you, when like you just promised something in the contract that within this time period I'm just going to sell it, otherwise my money is for you. My full money is for you, no need to refund. So that's what the contract has been given. So that's called as the expiry date. Expiry date will be like, for example, 1 week or 1 day or 1 month or 6 months or anything like 1 year. So you will have expiry like based on what kind of contract you're going to put. So if this expiry has come and if you didn't sold out your land or if you didn't earn a profit, then all your money will be going to the option sellers. So this how option expiry will work. If the expiry date comes, all your money will be packed into that person if the promised things has not happened. And next one is premium. So if you come to the premium, it will be considered as like maximum time. For example, if the stock price is $100, the premium amount would be considered as 1 to 10 percentage of the current price, 1 to 10 percentage of the stock price. That's how the premium will calculate. But in depth, if you go, we can upcoming videos we will see lot of calculations and logic things are there where if you go in depth, lot of things are like alpha, gamma, beta and theta, decay, time decay. So lot of things are there, so that you can easily understand how your money will be sunk inside if you are an option buyer, and how it's going to be profitable for option sellers. So we are just going to see in upcoming videos, but now just assume, see for example, if you have an $100, okay, for example, if you have an $100 of this current stock price, in that you can assume that the per share value is nothing but for example, if you are you're in stock market, you're just going to have a contract that you're just going to buy with 1 or 5% or 1 or 10% between that. For example, if the share price is $100, you're just going to buy for one share as a $5 and 100 shares, which is going to be $500, and you're just going to be an option buyer, so that the premium would be like $5 per share into 100 shares, which is going to be considered as 500 total. So it is it will be depend on each and every countries, because US options is little different, European option is little different, if you go with Asia it's little different. So here I just given a small example. So here if you see US share market, it will be considered as 100 shares as a one contract. So if you are going to buy if you are going to be an option buyer, or if you are going to be the option seller, you are going to pay the premium which is going to be equivalent to 100 shares. You're not going to sell one small land, you're just going to sell 100 small lands. So for that you will have the minimum amount of contract as a premium. You're just going to promise expiry date, and within that if you're not going to perform what you are given, then all your money will go to the option seller. So this how the things will work. And here I just given option type, which is like call or put option. Put option is nothing but right to buy. Like for example, if you take a call or put, call is nothing but if you assume that the market is going to go up, then you will focus on call. If you just assume, if you focus on the market is going to fall down, you will focus on put option. So call is nothing but focusing on uptrend, put is nothing but focusing on downtrend. So based on the analyze and based on the trend, you are going to assume that. And option styles, as I told you, options have different styles and different rules and different execution based on countries. Like American option is entirely different, European option is entirely different, and the Indian options, or for example the Asia options, entirely different. Okay, so don't confuse with these and this, but entirely the base level option is whatever we are just going to cover is going to suitable for all option traders. If you are doing options, it will be more and more helpful for you, because I'm just going to cover everything together as a single bundle. Okay, so that's all. These are the components you need to know. Very easy. I'm just going to make it even more easier, and I'm just going to make you even more understandable. If you have any doubt, you can put it on the comment, so that I will try my best to help you. Okay, we can see you on the next video.